Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
SoundHound AI, or SOUN, is entering 2026 as, well, not just a technology stock, but an absolute battleground equity. This name is one of the most fiercely contested holdings in the entire tech sector. It's operating right at the intersection of genuine, I'd say revolutionary AI promise and the ruthless realities of public market structure.
And that market structure is really the key driver here, isn't it? It's what's causing all of this volatility. I mean, we're looking at a company trading, near the 1060 range recently? Yet it's fundamentally divorced from any traditional valuation metric you could possibly apply. The core conflict is baked right into the trading mechanics.
Exactly. The price action is just defined by this extreme structural tension. As of early January 2026, we've seen the estimated short interest, it's resurged aggressively to around 101.8 million shares.
And to put that into perspective for everyone, that's 31.3% of the free float. This isn't just, routine skepticism. This is a massive, renewed bearish conviction, especially when you remember that brief tactical dip we saw in December when it fell back to around 80 million shares.
That resurgence just confirms that the skepticism is profound and structural, not just some transient market noise. The central question for this stock is, I think, very clear. Is SOUN a genuinely burgeoning titan of agentic IA that justifies this extreme hypervaluation? Or is it a structurally overvalued asset that's mechanically primed for significant fundamental collapse?
Right.
I hold the position that the market is correctly looking forward. It's anticipating a crucial, transformative strategic shift. That high short interest, the 31.3%, combined with critically low share availability, which, it constantly oscillates between 200,000 and 800,000 shares, it creates what can only be described as a coiled spring. Any positive news catalyst, especially on their pivot, it's going to lead to a violent short squeeze.
That's a compelling argument about market dynamics, I'll give you that. But let me offer a very different perspective, one based on, let's call it, financial gravity. That valuation premium is completely detached from reality. It reflects pure speculative zeal. We are talking about a price-to-sales multiple in the staggering 20 to 30 times range. I mean, just compare that to its direct peers. Cerence, another specialized voice tech player, it trades at a conservative 1.6 to 2 times sales. Even a specialized SaaS firm like C3.ai trades in the 5 to 7 times range. That enormous valuation gap suggests the market is just ignoring fundamentals and pricing SOUN for absolute flawless execution in a sector where failure is, frankly, common.
But my framing is that this strategic pivot is precisely what justifies the disconnect from peers like Cerence. We're witnessing SOUN intentionally exit that low-margin, cyclical business of licensing basic voice recognition and making a massive, massive leap toward high-margin agentic AI. And this shift is really being driven by the Amelia acquisition. Amelia instantly gives them maturity in enterprise SaaS, bringing established, high-value clients in sectors like financials and healthcare. It's a deliberate repositioning that demands a much higher multiple.
But the underlying tech that powers their whole business model it's fundamentally vulnerable, and that completely undermines the viability of their SaaS structure. Forensic analysis strongly suggests their foundational speech-to-meaning engine, the tech they built their reputation on, it relies heavily on manually programmed knowledge graphs.
Okay, so break that down for our audience. Why does that reliance on manually programmed knowledge graphs matter so much?
It matters because it destroys your operating leverage. An old-school system like that is essentially a highly optimized but very rigid decision tree. If you have to manually program every new context, every piece of industry jargon, every specific corporate policy, you just can't scale efficiently. Your service becomes inherently high cost to deploy and maintain, which completely erodes the justification for that high price-to-sales multiple that SaaS models are supposed to command.
Where I diverge, though, is on the trajectory of their future revenue. The company is strategically capitalizing on the massive voice commerce total addressable market, or TAM. They're moving beyond just recognition into actual transactions. I mean, look at the validated partnerships with major QSR chains like Chipotle and Jersey Mike's. The vision here is far broader than just speech recognition. It's about turning the car dashboard into an in-car wallet and an app store. They're building a transaction ecosystem, and that is a much higher margin recurring revenue model.
That transactional model is already springing leaks because of undeniable customer churn, a fact that management has, I think, tried to mask. The defection of Mercedes-Benz in 2025, which chose to integrate Google's frankly superior Gemini model instead, that's the smoking gun right there. Losing a flagship, highly visible partner like Mercedes proves there is no sustainable competitive moat against the hyperscalers. They're not building a transaction ecosystem, they're demonstrably losing the key footholds they need to even start.
Okay, let's address the finances directly. I have to acknowledge this substantial cash burn, a $109.3 million GAAP net loss in Q3 2025. That is a massive loss. However, the reported $42 million in Q3 revenue, representing 68% year-over-year growth, confirms rapid top-line expansion. It validates the strategy to acquire revenue and market share aggressively. You can't just dismiss a 68% growth rate.
Oh, I absolutely can, because you have to question the quality of that growth. The company's own disclosure said that the revenue increase was, and I'm quoting here, primarily due to acquisitions. When a company relies almost entirely on M&A to generate top-line numbers, you have what's known as a roll-up strategy, a strategy often used to mask underlying decay in the core business.
I would call it strategic acceleration.
If you strip out the inorganic growth from acquisitions like Amelia, the estimates suggest the core Houndify business's organic growth is negligible, maybe even negative. And the real issue is the burn rate. A $109 million quarterly loss compounded by buying your revenue. I mean, how many more quarters do they have before they need a highly dilutive capital raise that would just offset any stock price gains for shareholders?
That acceleration is necessary to achieve the scale they need to compete. The Amelia acquisition is designed to improve the margin profile and stabilize their business mix immediately. Rapid scaling in a high-growth sector often involves large, non-cash charges. But the market, I believe, looks past these accounting technicalities toward future EBITDA potential.
It's difficult to look past issues of integrity, though, especially when management's actions seem to contradict the narrative. Let's look at the pattern of opportunistic insider selling by the founder and CEO, Keyvan Mohajer, in late 2025. He sold 118,000 shares at $20, near a local peak, and then another big transaction on December 22nd, netting $1.6 million. If the agentic AI revolution he claims to have started is about to explode, why is the founder consistently reducing his stake at local highs? It sends a powerful negative signal to the market.
Well, I'm not convinced that every executive sale is a red flag. Executives often engage in pre-planned sales programs like sell to cover to manage significant tax obligations. The market tends to overreact. We have to focus on the core value. Mohajer's deep technical pedigree, a Stanford PhD, and the fact that he founded this company on a unique vision. The criticism about them halo-riding the legacy NVIDIA investment from 2017 is, in my view, it's market noise that obscures impressive technical execution.
But that noise is rooted in legitimate structural issues. You can't ignore the company's admission in March 2025 of material weaknesses in internal control over financial reporting. When the leadership team is hitting sell at opportune times and the company itself admits to material weaknesses and how it reports its finances, that stops being noise. It becomes a fundamental risk factor.
Let's pivot back to the competitive moat, because that's where the long-term value lies. I maintain that the Switzerland of voice AI concept is still entirely relevant, especially in the automotive vertical. OEMs like Stellantis are fundamentally resistant to handing over all their proprietary customer data and brand sovereignty to Google or Amazon. I mean, why would Stellantis allow Google to own the Hey Jeep experience? An independent partner like SOUN is essential for them to build custom, branded experiences.
That neutrality moat is already breached. Mercedes-Benz proves it. They weighed brand sovereignty against the undeniable technical superiority of Google's Gemini model, and the tech won. The advantages of the hyperscalers simply outweigh an OEM's desire for brand control, especially when building a competitive in-house AI system is astronomically expensive. And the rise of generative AI has lowered the entry barrier for everyone else, which just accelerates the commoditization of SoundHound's specialized layer, their tech risks becoming an expensive, unnecessary middleman.
But let's shift to the technical strength that continues to provide critical price support, regardless of this debate, the passive bid. This is structural support. Passive institutional giants like Vanguard and BlackRock are net accumulators. Vanguard alone holds over 43 million shares and recently increased its position by, 16%. These giants don't sell based on fundamentals. They buy because the stock is in an index. They effectively remove massive blocks of stock from circulation, which intensifies that coiled spring short squeeze dynamic.
That is a compelling point on the cold mechanics of passive money. But have you considered the active institutional conviction? While passive money flows in blindly, the smart, active money is running for the exit. We see clear evidence of this. Bank of America, a major active player, aggressively slashed its position by nearly 47%, liquidating over 10 million shares in the same period you mentioned Vanguard was buying. This signifies a fundamental active disagreement with the valuation. They are betting against the pivot.
Active managers, by their nature, have shorter time horizons. They're reacting to short-term volatility. Passive managers represent long-term market acceptance and provide a structural floor. And that support, combined with the high borrowing costs and low share availability, ensures this remains an inherently explosive environment.
An environment where the risk-reward is dangerously skewed toward risk. The market has priced SOUN for absolute perfection. They are ignoring that the company is bleeding cash, relying on expensive M&A to manufacture growth, and facing existential threats from companies with infinite resources and superior AI models.
So to summarize the discussion, the core tension here is defined by these two forces battling for control of the stock price. I see a successful strategic evolution underway. The market is beginning to price in the successful pivot to agentic AI and high-margin enterprise software via Amelia. The risks you highlight are counterbalanced by powerful technical tailwinds, the NVIDIA halo effect, and the immense short interest that guarantees explosive upside on any positive catalyst.
And I maintain that this company remains structurally a venture capital-style wager being played out in the harsh light of the public markets. They are plagued by those admitted material weaknesses and internal controls, and the astonishing valuation premium risks catastrophic compression. If the customer churn narrative, evidenced by Mercedes, accelerates, the stock will inevitably regress toward peer valuations like SOUN's. That would be devastating capital destruction.
So we fundamentally agree on one thing. SoundHound AI is undeniably a battleground equity. It presents a stark choice for investors. They have to weigh the potential for revolutionary growth as an independent voice commerce platform against the very real risks of competitive displacement and structural financial decay.
Indeed. The stock's price and its volatility, driven by that intense short interest and the lingering effect of the NVIDIA association, is locked in constant combat with forensic evidence of customer churn, the punishing high cost of scaling, and the relentless competitive threat from global hyperscalers. Investors have to weigh that risk against the reward very, very carefully.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.